Could your business's growth be hampered by the very structure of its financing? Have you ever wondered if the company offering you capital is playing by the same rules as a traditional bank? Today, we're diving deep into a question that's more critical than you might think for e-commerce businesses seeking funding. Is Wayflyer regulated as a financial institution? So, let's get to the heart of it. Is Wayflyer regulated as a financial institution in the same way a bank is? The short answer is, generally, no, not in the traditional sense. But that no comes with significant nuance, and it's crucial to understand why and what it means for you. Traditional financial institutions, like banks, are typically subject to extensive and rigorous regulation. This regulation is designed to protect consumers, ensure financial stability, and prevent illicit activities like money laundering. They fall under the watchful eye of central banks, financial conduct authorities, and a host of other governmental bodies. This means they operate within a tightly defined framework regarding capital requirements, lending practices, consumer protection, and transparency. If you get a loan from a bank, you're dealing with an entity that's held to a very high standard of oversight. Wayflyer, on the other hand, primarily offers revenue-based financing and merchant cash advances. These financial products, particularly in some jurisdictions, are often structured in a way that allows them to operate outside the strict definitions of traditional loan, and therefore outside the purview of certain banking regulations. They're often classified as commercial transactions or asset purchases, the purchase of a portion of future receivables, rather than traditional loans. This distinction is key. Think of it this way. When a bank gives you a loan, they are lending you money with the expectation of repayment plus interest, and they are regulated on how they do that. When Wayflyer provides capital, they are typically advancing you funds in exchange for a percentage of your future revenue. This isn't a debt in the conventional sense, where you have a fixed repayment schedule regardless of your sales. Instead, the repayment fluctuates with your business's performance. This innovative structure, while beneficial for businesses with unpredictable revenue streams, can also place it in a different regulatory category. Now, this doesn't mean Wayflyer is operating in a wild west of unregulated finance. Far from it. While they may not be regulated as a traditional bank or lending institution in the strictest sense, they are still subject to a range of other laws and regulations that apply to businesses, particularly those handling financial transactions and data. For instance, Wayflyer, like any legitimate business operating internationally, must comply with anti-money laundering (AML) and Know Your Customer (KYC) regulations. This means they have obligations to verify the identity of their clients and monitor transactions to prevent financial crimes. Their privacy policy explicitly states their commitment to protecting personal data and complying with data protection laws like GDPR. This is essential for building trust and ensuring the security of sensitive business and financial information. Furthermore, they are subject to commercial contract law. The terms and conditions of their financing agreements are legally binding contracts, and any disputes would typically be resolved through commercial courts or arbitration, depending on the terms. While this isn't the same as banking regulation, it still provides a framework for legal recourse. It's also worth noting that the regulatory landscape for fintech companies is constantly evolving. As innovative financial products become more widespread, regulators in various countries are assessing how best to oversee them to protect businesses and maintain market integrity. What might be unregulated today could be subject to specific regulations tomorrow. Some jurisdictions might be more proactive in regulating revenue-based financing or specific aspects of it. For Wayflyer, being a global company, this means navigating a patchwork of regulations across different countries where they operate. While their main entity, Wayflyer Limited, is registered in Ireland, they have a global presence. This requires adherence to local laws and, in some cases, working with regulated financial partners. For example, Wayflyer has partnered with large financial institutions like JP Morgan, which are heavily regulated. These partnerships can provide an additional layer of credibility and, in some instances, access to the balance sheet strength of regulated entities. So, what does this all mean for you, the e-commerce business owner? Firstly, transparency is key. When considering financing from any provider, especially an alternative one, thoroughly review their terms and conditions. Understand how they are structured, what fees are involved, and what happens if your revenue fluctuates. Wayflyer emphasizes transparency in their fee structure, typically a fixed fee of 5 to 10% of the advance amount. This is different from interest rates and compounding interest, which are typical of traditional loans. Secondly, data security and privacy are paramount. Wayflyer collects a significant amount of data about your business. Sales data, marketing data, bank account information, and more to assess your eligibility and performance. Their commitment to GDPR and SOC 2 compliance, as stated on their website, is a positive indicator. But always do your own due diligence on any platform handling your sensitive information. Thirdly, understand the nature of product. Revenue-based financing is designed to align repayment with your cash flow. This flexibility is a major advantage for e-commerce businesses, but it's not a traditional loan. The legal and regulatory framework around it differs, and understanding that distinction is vital. It means that while you might not have the same consumer protection avenues as with a bank loan, you're also entering into a different type of commercial agreement. Fourthly, consider the reputation and partnerships. Wayflyer has achieved unicorn status and has deployed billions in funding to thousands of brands. Their partnerships with established financial players like JP Morgan and their backing by major investors speak to a certain level of legitimacy and financial strength. While this isn't a substitute for direct regulation, it offers some assurance. In essence, Wayflyer operates in a space that bridges technology and finance. They leverage data analytics and innovative financial products to serve a market segment often underserved by traditional banking. While they may not be regulated as a traditional financial institution, they are subject to commercial laws, data protection regulations, and anti-money laundering frameworks. The flexibility and speed they offer come with a different regulatory profile, one that emphasizes commercial agreements and data compliance rather than strict banking oversight. For any business, the key takeaway is always to understand who you're dealing with, what type of financial product you're engaging in, and what legal and regulatory protections are in place. Don't assume that because it involves money, it falls under the same rules as your local bank. Instead, ask the direct questions, read the fine print, and seek professional advice if needed. With that said, thanks for watching, and until next time.